I've been Reppond. Today is March 27, 2024. Thank you for watching my YouTube broadcast. So I'll give you my views kind of on the market conditions, and then I'll get into the charts and graphs. The market right now is at an inflection point. It has gone up for about 4 months, 4.5 months, 4.5, and is now kind of run out of steam. And so is it going to keep on going? Some people think it will. Is it going to go through a pullback, come back down before it goes back up? You know, some people believe that. That's kind of my view, is I think we are in for some kind of a pullback. I don't think it's horrible. I think it's normal market correction that most people live with, normal volatility, you know, minor ups and downs, fine, you'll live with it. But long term, as we look out over a period of years and years, we are building to the point where a bubble, to the point where at some point it will become unsustainable and a major correction, I'll call it a crash, will have to happen. I don't think it's right around the corner. I think it's down the road a piece, and the general market conditions, in my opinion, are favorable enough to continue to push the market upwards, at least for the time being. Okay, let's get into the dashboards, and this is the dashboard for the indexes. Now, these are 4 U.S. equity indexes: the S&P 500, the NASDAQ 100, the Dow Industrials, and the Russell 2000 Small Cap Index. These are represented by exchange-traded funds listed on the left column. There are 2 international indexes, or ETFs. One is EFA, which is the developed markets, and one is EEM, which is the emerging markets. And so now you have six indexes, plus the 7th is the long-term government bond ETF, TLT. So I'll put all of those in. So it gives you a pretty macro view of what's going on with the U.S. equity indexes, from large to small, growth to value, and then the international, developed, undeveloped, and then the long-term bonds. So it's a little bit of everything. As you can see to the right of the chart with green dots, these are the indexes that are above their 20, 50, 100, and 200-day moving averages. So very positive, very favorable. The last one, the long-term government bond, moved up a little bit this last week, so that it's still negative for the year, but it's below 2 of its moving averages and above 2 of its moving averages. Still quite negative, still down almost 5% for the year. The next one is when I take the S&P 500 and I break it apart into its 11 sector components. You have the everything from on the top, energy, financials, industrials, technology, etc., all the way down to the bottom, and that's real estate and telecommunications at the very bottom. Again, you can see, because of the green dot, red dot thing, you can see virtually every sector is above virtually all of their moving averages. The last 2, especially telecommunications, is showing that it's negative below all 4 of them. But other than that, I mean, they're doing pretty well. So the yellow box shows the amount of change for this last week. The pink box shows the change year to date. So you can see the top sectors, or the top 4, are up 9 or 10%, and then it drops down from there. So again, for the first, not quite quarter, but 2+ months, it's been very favorable market conditions. Okay, S&P 500. The S&P 500 had a positive week. So this is an 18-month chart. It's a weekly chart showing 1 move equals 1 week. And so you can see at the very end of it, at the far upper right, where the the line that goes up and down, that's the equity line for the S&P 500, has a tick up at the end, and that represents the gain that it had for this past week. So again, I'm looking at an entire week, which is made up, in this case, of 5 days. I drew a line, a black line, showing this over this 18-month period. You can see the direction. It's been up and down, but generally speaking, it's up, and where it is relative to its 20-period moving average. I did the same thing with this. Now, this is a relative strength chart. This shows the relative strength of growth stocks inside the S&P 500, the largest 500 stocks. So you would see growth stocks would be companies like Google, Apple, Microsoft, Amazon, Facebook, etc. Those make up growth type stocks. So there's a growth index, SPY-G. Divide that by SPY-V, which is the value companies, companies like Boeing and Pfizer, JP Morgan, etc., companies like that, which are more old economy stocks. And they tend to move very differently. Sometimes growth is in favor, sometimes value is in favor. And this chart shows that. So if it's going up, it shows that growth is in favor. When it goes down, it shows that value is in favor. And rather than just take the index, the S&P index by itself, I split it into two parts and look at which part is the strongest. Also, also the large cap SPY, which is the S&P 500, those 500 companies, when you divide that by the small companies, the small cap ETF, IWM, then if it goes up, you can see how much large companies are outperforming small companies. When it goes down, it shows that small companies are outperforming large companies. And so it's just another slice of the market, looking at large versus small. And you can see the last couple of weeks to the far right has been in an upward direction, which means growth, that large cap has been in favor over small cap. Bonds have continued to struggle, and this is a 54-month chart, so 4.5 years. You can see the long-term direction and the short-term direction is all down. So while stocks, equities, are increasing in value, bonds, generally speaking, have been decreasing in value. So when you put those two together in a typical stock bond 60-40 portfolio, which many people use, you can see that the bond portion of the portfolio is putting a drag on the stock portion, making the return fairly anemic. I won't say negative because I don't think it's negative, but it could be in some cases, but I think it's certainly, if you look at a 60-40 portfolio, you would probably say it's anemic, and this is the reason why. The U.S. dollar. The U.S. dollar continues to go up. It has gone up both in a short-term period, you can see to the far right, and in an intermediate term period, which I would call a 36-month period. Over that entire 36 months, the direction, generally speaking, has been upward, and in the short-term period, same thing. Gold had a huge last couple of weeks, but this past week, it was a little bit of a pullback, and the last couple of weeks, and but it again has been in an upward direction. Silver had a down week this last week, not anything major, small pullback, and but it has been up and down a lot, and the general direction in 18 months has been positive, but certainly a lot of movement up and down. When I compare the two, I put silver as a numerator, gold as denominator. How is silver doing relative to gold? And you can see that the general direction for my black line, the general direction of silver has been declining relative to how well gold has done. They both have been up, but silver has been up less, which makes this relative strength chart favor gold. Bitcoin. Bitcoin has been in an upward direction and has gone through a short-term pullback. As of today, that I'm recording this, it's going through another huge move up. So, but again, generally speaking, the direction of Bitcoin has been positive. Volatility. Volatility fell down to 13, so it was up above 14 and down as low as 12 something, and now it's down around 13. So low volatility, which speaks favorably to equities. The Asbury six metrics that Asbury uses to measure the equity market in general. Last week there were 2 negative and 4 positive. This week there's 1 negative and 5 positive. Again, moving more in a positive direction for the U.S. equity market. Asbury does what they call a cross-asset relative performance chart or comparison, showing different assets or classes of stock versus others. So this would say, I'll just go through this, and these are the ones that meet all 3 criteria the last week, the last month, the last quarter. Stocks outperform bonds. High volatility or higher beta stocks outperform low volatility. Large cap outperform small cap. Broad market outperform the blue chips, the Dow Industrials, and the broad market also outperformed the NASDAQ. Growth outperformed value. U.S. outperformed both the emerging markets and developed markets. Corporate bonds outperformed government bonds. U.S. versus the world. So the U.S., when compared to other countries, is favorable. You have to kind of look at this. I'm looking at these 3, the last week, the last month, the last quarter. U.S. has outperformed Chile, Brazil, Canada, Switzerland, Germany, France, the Eurozone, Malaysia, Hong Kong, Singapore, India, China, Thailand, the Pacific, New Zealand, Australia, and emerging markets. So a lot of them. The ones that have outperformed the U.S. in all 3 time periods are Spain, Japan, and South Korea. I do this chart showing the U.S. versus Switzerland. Switzerland is the ETF, EWL, and of course the U.S. is SPY. And so from May to present, this is what, okay, just the performance. This is not the economy or the currency. This is the performance of the stock market in general in that country versus our country. So from the black line, you can see the direction of the U.S. versus Switzerland. So I already told you that the Eurozone and France and Germany were outperforming all of those. I just picked on Switzerland, but I think it's the best chart. But it gives you a sense that the U.S. is doing quite a bit better than other countries, both many of the Asian countries and certainly the European countries and Latin American countries. Okay, gold and silver. So gold, the spot price as of last Friday was $21.64, down 0.5% from the previous week. Silver, $24.64, down 2.1% from the previous week. And the gold-silver ratio is 88:1, meaning gold is 88 times more expensive than silver. And that's a ratio that many people follow. So a box of 500 generic ounces, bullion it's called, of silver is currently valued as of Friday at $12,860. This includes $1.08 markup over spot. I've told you that spot was, what was it, $24.64. So you add $1.08 to that, and you get for 500, $25.72, and then there's another 50-cent markup on top of that if you buy it in a smaller quantity of 1 tube at $26.22. And I got that information from my son Preston. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.